The Bank of England didn't cause the South Sea bubble, but it enabled the men who did. In 1694, England's government faced a problem. It was broke. War with France had drained the treasury, so Parliament did something radical. It chartered a private bank, the Bank of England, and gave it a monopoly on issuing paper money. In exchange, the bank loaned the Crown £2 million. This wasn't charity. The bank made its profit by controlling the currency itself. But here's what matters. By 1720, that same institution would stand at the center of history's most explosive financial catastrophe. So why did a central bank enable a bubble instead of prevent one? The South Sea Company started as something almost reasonable. In 1711, the government created it to consolidate its war debts. Investors bought shares, and the Crown promised the company exclusive trading rights with Spain's South American colonies, hence the name. On paper, those colonies meant gold, silver, and endless wealth. Nobody actually knew what was there. The company hadn't sent a single ship. But the Bank of England did something crucial. It began accepting South Sea Company shares as collateral for loans. That decision was the fuse. If the bank would lend against South Sea shares, then shares became liquid, easier to buy, easier to borrow against. Prices climbed. In 1715, a share cost £100. By 1720, the same share sold for £1,000, 10 times higher, not because the company had mined anything, not because a single successful voyage had returned, but because the bank's willingness to finance share purchases created artificial demand. The machinery of modern central banking, designed to stabilize markets, became the engine of speculation. Directors of the South Sea Company understood the game. They borrowed from the bank using inflated share prices as collateral, then used those loans to buy more shares, driving prices higher still. It was circular, self-reinforcing. The bank didn't invent the scheme, company insiders did, but the bank's liquidity made it possible. By mid-1720, nearly everyone in England with spare money owned South Sea shares. Servants, widows, clergy. The bubble had become the market itself. Then in September 1720, the scheme collapsed. Directors quietly began selling their own shares at the peak. Insiders fled, the public noticed, panic followed. Within weeks, the share price crashed from £1,000 back toward £100. Fortunes vanished overnight. The Bank of England, holding thousands of worthless shares as collateral, faced a crisis of its own. It had no insurance, no circuit breaker, no regulatory framework to prevent what had just happened. The bank survived because it was too important to fail. Parliament bailed it out, restructured its holdings, and moved on. But the lesson stuck. A central bank could either stabilize markets or fuel them depending on how it used its power. The Bank of England didn't cause the South Sea bubble. The greed and deception came from the company's directors. But by lending freely against speculative assets, the bank had removed a crucial friction from the system. It had shown that modern banking could amplify human folly at scale. That's why the South Sea bubble matters today. It was the first time a central bank had to grapple with the consequences of its own monetary decisions. It taught regulators slowly that controlling the money supply means controlling the fuel for speculation itself. The Bank of England didn't intend to create a bubble, but intention doesn't change the outcome. Lend too freely on shaky collateral and you don't stabilize the economy, you prime it for collapse. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for a new financial bubble and the human machinery behind it every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.